Good morning, everyone. Thank you for joining us for this session of getting your business transition and succession plans back on track. We're happy that you could join us virtually today, and we'll get to panel introductions in a moment. What I wanted to do first is sort of provide a scene-setting little paragraph related to the state of affairs. I am an attorney at Seyfarth Shaw, which is one of the sponsors where I'm a partner. My practice area is in the corporate practice where I work on transactional matters of all types, including M&A, venture capital finance, private equity finance, and technology transactions. And what I've seen over the course of the last 6 months is, in part, a lot of business owners and executives working very hard to manage a difficult environment. They're very much focused on trying to get to the other end of the tunnel. And given those circumstances, a lot of people can put off things. Many people were in the early part of the year planning for a business sale. They may be at the end of their period where they'd like to retire. We have other people that are focused on making their succession plan come to reality by bringing in alternative management, perhaps taking over for family ownership, or alternatively, perhaps taking over for a president, someone at the top level, at the CEO level, to bring in a new generation of management. And those plans get put by the wayside. So as we continue to move forward and things stabilize a bit and we begin to think about getting to the end of that tunnel, the topic of this panel is really to focus on how do we get back on track. So with that, let me do a few introductions and I'll ask each of you to say hello at the end of your introduction so everyone knows who you are. First of all, Rick Feller. Rick has been a commercial lender to Chicago area middle market businesses for over 30 years. First at American National Bank for 10 years, 15 years at LaSalle National Bank. And then Rick joined the commercial banking team of MB Financial Bank in 2007. MB merged with Fifth Third Bank in May 2019. His industries served include manufacturers, distributors, not-for-profits, and service companies. Rick also serves in a finance role at several not-for-profit organizations in Chicago. So if you would, Rick, say hello.
Hello, glad to be with you all today. Looking forward to our conversations.
Great, thank you, Rick. Our next speaker is Rob Eisenstadt. Rob is a partner with the Cutchins, Robbins, and Diamond CPA and consulting firm with offices in Chicago and Schaumburg. Rob works with closely held and private equity owned businesses in the lower middle market, focusing on financial reporting, tax and strategic planning, and mergers and acquisitions due diligence and consulting. So go ahead, say hello, Rob.
Good morning to everyone. Looking forward to the conversation.
All right, great. Tom Hazlitt is a senior consultant with Productive Strategies, a management consulting firm specializing in business-to-business sale process, improvement, training, lead generation, and marketing communications. His clients include high-tech manufacturing, distribution, professional and financial services, law firms, and nonprofit organizations. Prior to joining Productive Strategies, Tom was a president and an owner of a retained executive search firm working with major companies across the country. So Tom brings a real practical fellow president type role to the table. Welcome, Tom.
Thank you, Bob. Good to be here.
Great. And finally, Joseph Kai is a shareholder and the vice chairman of the Finance and Transactions Group at Vedder Price, a global AmLaw 125 law firm headquartered in Chicago. Joe practices in the areas of mergers and acquisitions, private equity, venture capital, corporate, securities, business law, and focuses on middle market, public and private company transactions and financings. Say hello, Joseph.
Welcome, everyone. Looking forward to our conversation.
Great. So what I would encourage all of you in this session that are attending, if you have questions along the way, please use the chat function. Feel free to submit some questions, and we will come around to those, or I will include them as the panelist is speaking. We want to make this a session that gets your questions answered, and if we have time at the end, we'll open it up for individual questions as well. So to get started, Joseph, I think we can go to you to set the stage a little bit concerning the high-level decision-making concerning direction that business owners need to take or might want to think about taking in this time. So what are some factors that a company should consider when deciding whether or not to make a transition of leadership or perhaps sell instead?
Sure. So some considerations, particularly in this marketplace, I'll just point out with COVID, if you were in industries that are particularly adversely affected, so hospitality, travel, et cetera, it really is a time to think about how you're going to continue to either evolve your business to adapt to COVID, or if you're just looking to exit. I will say that exit values for those affected industries obviously have changed. So assuming you are not in one of those specifically affected industries, then it's really dispassionately looking at your market, looking at your company, and looking, frankly, at what succession plan you have presently in place. So are you the patriarch or matriarch of the company? You started this, it's been your baby, you're in your 50s, 60s, 70s. Have you brought up successive leadership to take on the mantle and be able to drive growth in the company for the next 5-10 years? Then it's focusing on making sure that next generation is properly incentivized and looking for value to create over time. If succession plan hasn't really been top of your mind, and perhaps you're getting a little bit older, or you don't see a next generation immediately coming up in the ranks, perhaps it's something to think about a sell process where you'd hire an investment banker depending on the size of your transaction. You'd run an auction process. You'd see if you can't get fair market value for your company. But it is, unfortunately, it is contextual in terms of particularly your company, your position within the marketplace, what you see within your own organization in terms of your ability to successfully pass along the business to the next generation or to a third-party management team.
That's great. If a business owner is deciding to make a transition to new leadership, what are some of the challenges that you see that people encounter, require good planning, require attention?
Absolutely. So first and foremost, if you're bringing in third-party management, so you're going to want to hire, again, depending on the size of your company, you may want to hire a recruiter, a headhunter to find you the right fit. If you're looking for a CFO, you're looking for a COO, you're looking for a CEO, and then relying upon some of the point of view that they bring to the table in terms of what is market comp and what are market terms to employment. So if you are looking to transition your business, the day-to-day management, the C-suite to a third party, you will want to make sure that they have the right economic incentives, first and foremost, to drive that value, as well as protecting you contractually with the right provisions such that they can't simply take, for instance, take your IP and start their own competing business on their own for their own benefit, or simply pick up and leave in the middle of a critical time for the development of your business without any notice, leaving you in a lurch. So it's a mixture of economic incentives together with contractual thoughtfulness.
Makes sense. Now, if on the other hand, you're thinking about selling your company and, particularly at this challenging time, there are a variety of things that might make it seem inconvenient, but we're talking about planning for a better time ahead. What are some of the things that you're advising your clients to do to get ready for a potential transition that might involve a liquidity event of some kind?
Yeah, absolutely. So the first thing is to look at your internal record keeping and to make sure that you can produce information to a would-be buyer in a seamless fashion if necessary. So that would mean, from a contract perspective, making sure you're keeping track of your contracts. From a minute book and stock ledger perspective, making sure you understand your own capitalization, who owns your stock, making sure all that is well documented. Some things that for small business owners that we see a lot is that companies that have elected, take for instance an S corporation election, they don't keep the records on proving out to a buyer that they actually are a valid S corp. So record keeping, corporate governance, stock ledgers, minute books, and then really taking a look at your structure and maybe even talking with an M&A person, either an investment banker or an M&A attorney. How can I prep for a sale with respect to tax planning? Do I need to reorganize my company such that the liquidity event that I'm looking for will be made in the most tax efficient manner as possible?
One final question, Joseph, and we'll come back to you. But in this particular challenging time, are there things that you're advising your clients to do to get their financial house in the kind of order that will be presentable and ready for market when the market, is better for them?
Sure. So on the financial side, whether you have an audit, whether you use reviewed or compiled financial statements, you will always want to have, again, just good record keeping on your financials. So even if you use QuickBooks, you just want to make sure that you're using that consistently throughout, so that someone, a would-be buyer, could look back at your financial statements, usually 3 to 5 years at least, to unpack your financials. And frankly, if you do use a review, a compilation, or an audit, recognizing that even with those financial statements, a savvy buyer will often hire an accounting firm or an investment bank to do what's called a quality of earnings review. And that essentially tries to break down your financials so that they can get a distillation of the quality of your EBITDA number, which oftentimes drives valuation.
Right. Great. Thank you, Joseph. And again, I see we have a few people that joined after the session started. If you have particular questions in this area that are pertinent to your business, feel free to submit a question by chat. We will open it up in a little while if there are questions you'd like to verbalize instead. Let me move over to Tom. Tom, as a former individual business owner, manager, and now as a consultant, I'm sure you have views related to how you make a transition to good new leadership instead of a sale, as well as how you go about retaining your key people. You obviously don't want to lose your key people in the middle of any process that might throw the process on track. So give us your general thoughts on how business owners should manage a transition to a next generation of leadership situation.
Well, first of all, start early. It should be. It really should be part of your ongoing planning process. Everything from playing what if. I mean, if you are even if you're not in a position to be in transition, or if you're not thinking immediately about it, you need to if you want your business to survive and prosper, you need to understand, you need to make it known, and you need to have a very good idea of a succession plan. What if, God forbid, you test positive, or if what's going to happen, and how is it going to affect the organizational structure, and who is in line to keep the business running and keep the business growing. I think it's important to have a written plan. I mean, I think we all agree that strategic planning, it needs to be done, and you need to understand what your goals are for the business for the long term, and as well as medium term, and how that and as part of that, what is the organizational structure look like, and who are the key players, and who needs to be retained, and this is very important. I think the other thing you need to do is particularly in a smaller entrepreneurial venture where you are the rainmaker, you are the person who's responsible for really keeping the business going. You need to do a realistic analysis of yourself and of your management style and of the people around you. And you need, this is hard for people to do. They don't want to do it because they want to, it's the idea of, I want to do my business. I'm not worried about self-analysis, but it's very important to understand your strengths, the strengths and weaknesses of those who are key managers and executives in your firm. Now, if the transition to new leadership involves family members, that can be pretty touchy. That's something that people that run family businesses where family members are involved know that the dynamics and the potential for friction and for personality quirks and the whole thing is magnified. And the first thing you need to do is you find out is there anyone interested. I mean, people might have somebody that the son or daughter couldn't get another job, or they're in between, so they're on the payroll, but they're not engaged. They're there to do their job, but they really don't want to take over. And then you need to evaluate skill sets and educational background. And for someone, one of the things that I've seen in my experience over the years is that family members who have never worked anyplace else, it can be a daunting task for them to come in and take over the management of a company. And I've often counseled people that have young people coming out of college who they know that eventually they're going to take over the business. Have those people go work somewhere else for a while, because the idea of learning new things and learning from other environments can be very important in terms of running a business. I think one of the things that you need to do in a transition of this nature is you need to help in the transition, and so which means you can't just turn over the keys and walk out. That's not that you need to help in the transition, but you need to stay in the background. In other words, you need to define your role, and you need to give the person to whom you're giving the leadership the chance to grow and a chance to put their own mark on the business and the chance to make a mistake without you jumping in and immediately correcting, and then confidence in that person's leadership is going to be greatly eroded. And I think that in terms of doing this, very often it's important to get outside help. If you can get a trusted advisor, or if you can find somebody that has the expertise and who you can respect, and who can say no to you, and who can give you advice you might not want to hear, that is very important, particularly for smaller businesses where the structures is dependent upon an individual.
That's great, Tom. I think, certainly I've seen in my practice the circumstances where families try to go through that transition to the next generation, and it doesn't quite work out. And it leads to a real decline in the value of the business. So there is an alternative, which is, moving forward with the possibility of bringing in an outsider to that individually founded business rather than selling it and seeking outside assistance, as you said a little while ago, but doing it in a fashion where you bring in a true outside executive to take over for you. What are some of the things that you need to do to go through that process successfully?
Well, I think there are a couple things. First of all, you need to understand whether or not you want to use an outside resource or you want to do it in-house. This can depend largely on, is there a known universe of potential candidates that you know of? that have the skill sets and have the track record and have the kind of cultural fit that you're looking for. And what that, as opposed to going to an outside firm, to an outside help. And if you're going to engage a professional search firm to help you, a couple things you need to know. First of all, there are basically two types of executive search firms: the retained executive search firm and a contingency executive search firm. And the difference is that a retained firm is a consultant that you hire, and you agree to pay a certain amount of money, be it a fixed fee or a percentage of compensation coming in, but their fee is not contingent upon the hire that they make. Now, what this allows you to do, allows them to do, is to be a genuine outside counsel. I mean, their job is to help you make the best possible hiring decision, not just present you with a slate of candidates. And now their contingency firms there are good ones, there are bad ones, there are good retained firms and bad retained firms, and you need to do your homework in terms of looking for an outside resource. But I think the key thing is to understand really what the position is going to be like. In other words, you need, even though you've done this for years, you've been the person in charge, you need to put together, and this is where an outside firm can help, a comprehensive position description, which is, and it needs to be written down, needs to be memorialized. And I've seen this done where there can be 4 and 5 pages, and it can be everything with the kitchen sink. But you need to do a comprehensive position description, and then you need to pare it down to the critical factors, the 3 or 4 things that you must have, and the rest are gravy. And that's in terms of skill sets, management style, which is to say, if you're a company right now that's struggling, or if there's been some difficulties, or you're in a tough environment, you may need someone to come in who is a strong personality and someone who will take names and actually take charge of changing the culture. Or if your company is doing well and you're transitioning out, you're either going to retire and you want to make sure that the company is in good hands, that may take a different kind of management style. And also you need to understand what is the culture of your company. And that's something that sometimes it's good to get an outside opinion on, because you've been too close to it forever. The other thing you need to consider is you need to factor in other key managers, their role and their reactions. Because if you have somebody that you can't afford to lose, or if you have somebody that if they were to walk out, it would be a big, a very serious loss to your company, you need to consider them in the process as well. One final thing I'll put out here is when you are going about the process of interviewing candidates, outside candidates, I've seen this time and again, where companies will come in, and as I say, if you're interviewing, you need to ask, don't tell. And you need to have questions that you need to have answered that are going to get to the information that you need to make a good decision. And then you need to make sure that everyone in the interviewing process asks those questions, or ask questions that will allow you guys, or you gals, but allow allow the team to make an informed decision, and not to just sit down and spend, you have an hour interview, you spend 47 minutes of it describing your company and all you've done, and that should not be the focus. Because if a candidate is coming in, theoretically at least, they've done their homework on your company. So you're not trying to sell your company as much as you are trying to find out the information you need to make a good decision.
That makes sense, Tom. You talked a little bit about how during the process you want to make sure that your team is being held together, key employees are being retained so that new management has a good team to work with to make a smooth transition. what are the things that you suggest in order to help with keeping the team together, making that smooth transition along with your new executive, and ultimately leading hopefully to a successful process?
Well, there are three things that I can think of. First of all, you need to actually find out who you can't lose. I mean, if there are
Right.
2 or 3 key executives, you're going to need them. Number one, you need to identify who they are and make sure that they're involved in the process and that they realize their value to the company. And sometimes you may have somebody with it that thinks that they should be promoted, and you need to make sure that you can have a good conversation with them and tell them why right now that's not the best idea for the company, but that they need to be engaged and they need to be involved and they are valued. And then I think one of the important things is that whoever the new leader that you do hire, they need to have the final say. I mean, obviously, as I mentioned before, you need to be there for the transition, or you need to facilitate the transition in terms of making sure they understand why this person should be there. But in a final analysis, it's up to you to let the new leader make the final decision on that. And again, I think it helps at any stage of this process to have good written position descriptions that outline the responsibilities and the what success measurements are for your executives, so that they know, and so that it just helps clarify things. And the final thing that I will say is, if in fact you do need to pull a plug, if you do need to terminate people, you need sound HR and legal guidance, because I've seen some real horror stories where someone who was terminated and it was not done properly, it was not done the right way, and lawsuits and reputational damage to a company can be quite severe.
Very good. One last question for you, Tom, before we move on. I think the thing that I see for a lot of business owners and families that decide to transition to executive management is simply this: letting go and allowing the executive to, in fact, carry things out without interference and without everybody who is on the existing staff looking to the old owner or former executive. So how do you advise clients as a consultant with respect to that transition themselves?
Well, to be honest with you, I mean, I think that's a very important juncture where if you get an outside trusted advisor, somebody that can come in who has the experience and can give advice and can channel your emotions, and it's a tough thing to do, because generally transitions of this nature are companies that have been built from scratch, or where somebody has been there a long time, they've had success, and they know they know damn well why they've been successful. But they really need someone they need a governor, and they need someone that can help to facilitate the process. And I really think that is money well spent.
That's great. Thank you, Tom. Let's move over to Rob. Rob, you've got the potential of doing a transition along the lines of what Tom was speaking of, but we also have those circumstances where people, as a part of their transition, think to themselves, I'd rather not go through that. I'd rather not think about having a transition to a next generation or to a new executive. It's just too much trouble. Let me try to take the value that I've built off of the table. But these are tough times. So how does someone go about these days of determining whether a sale is a logical thing, the timing of that, and how to go about valuing a business, particularly when you might be having a lot of trailing financial statements that don't look too good?
Thanks, Bob. It's certainly it's a difficult decision at any time to decide whether to sell your business. And in these uncertain times, it feels even more complicated. While it may feel some aspects of the situation have created more confusion, there's still some basic factors you need to assess in regards to your motivation to sell, why do you want to do it, and underlying pluses and minuses in the business. The issues influencing your decision to sell may also influence who will make up the pool of potential buyers or investors, as well as sources of capital and valuation. Right now, we're seeing many businesses and industries under a stranglehold in this economy, and the pandemic, as you know, has created conditions that can severely limit supply and demand. For some of those businesses, absent continued federal or other kinds of financial support, we may see no choices but for those businesses to shut down or potentially identify a buyer that's going to come along at a severe discount in valuation. On the other hand, there are some businesses that have continued on a strong footing, and many showing surprising growth during an economic downturn. These businesses may find unusual opportunities right now in appropriate strategic markets. While financing has generally become more complex, and Rick will probably tell us a little bit more about that aspect, there's still no shortage of potential buyers in the marketplace. Without a doubt, the downturn has slowed down and stalled many transactions. So the fact patterns need to fit well in order to drive a deal through right now. And in many cases, alternate structures are going to be necessary in order to get over the hurdles that would prevent a transaction from closing. But studies have shown that large companies continue to be attracted to middle market, lower middle market companies in an effort to propel their own growth. The smaller companies are more nimble in responding to changing customer demand, breaking paradigms, and can be more effective at rolling out new technologies and innovations. And that helps from a valuation standpoint. Assuming you want to seriously look at a sale process, so as you said, how do you determine value? Value in the end is going to be based on what a willing buyer is going to agree to pay a willing seller, but there are some guidelines you can use to gauge a range of values for your business. For many years, we were used to the back of the envelope method that people would do in a restaurant booth to figure some range of value. But business valuations done by a merger and acquisition consultant or investment banker will typically use three generally recognized valuation approaches to estimate a business enterprise value: the market approach, the income approach, and the asset approach. And their goal is to harmonize those valuation methods in order to arrive at a consensus valuation. Buyers typically are going to run through this formal process, and increasingly we're seeing sellers also utilizing this formal analysis to assist them in positioning their companies for sale. The asset approach basically is looking at the underlying balance sheet, what's your status in your receivables and your inventory, what's happening with your property and equipment, if it's significant in the business, what's its appraised value, which liabilities are going to require repayment. And for a struggling business, that may be the clearest valuation method. The market approach is focusing on comparable companies with similar operating characteristics or that have concluded transactions in the latest 12 months. There are a lot of sources out there tracking deals and for public and large privately held companies for that method. But adjustments usually are going to be necessary to address the size disparities between the sample companies and the target seller. The income approach is probably what we're most familiar with, using some kind of multiple of EBITDA, although in today's environment, we're now hearing reference to something called EBITDAC, and whether to add back a COVID factor to earnings measurements if companies have really been impacted unusually, which many have. A normal analysis will also attempt to add back owner preferences and perks that are historically paid by the business, but would not expect to continue with an unrelated buyer. Examples are personal entertainment, vehicles, excess owner and family compensation and benefits, above market rent for related party leases. When preparing for a sale, it's a good idea to consider paring back some of those perks over a period of time. When buyers come in and look at large lists of add backs, it tends to create a lot of noise for potential buyer in assessing value of the business, and it also complicates the due diligence process. In addition to earnings, don't forget about your balance sheet aspects in terms of cash flow. If your receivables are impacted by extended terms or seasonal adjustments, do your customers have rights of return for excess inventory? Could affect your receivable realization. Are there related party receivables out there that might be outside the normal operating business? How is your inventory aged and the obsolescence factor? We've certainly seen over the years many businesses held on to their inventories in hopes of eventually for sale and avoiding taking financial losses. But those excess inventories don't help when valuing a business for sale. Valuation of excess inventory is rarely a positive aspect in a sale negotiation and often can sour a potential buyer in a business. In a recent transaction I was involved with, the seller wound up having to agree to retain a component of his company's inventory that the buyer was just unwilling to pay for. Don't lose sight of the payables and liabilities that the buyer might be assuming, and watch out for any related party transactions on that side too. As was mentioned earlier, some companies track their financials on GAAP, some on tax basis, and it's important to be clear with a potential buyer as to what that might impact on the value. And all these issues are typically reviewed for at the due diligence level. And multiples applied to business value will be influenced by many factors, including size of the business, industry, customer concentrations, and business synergies.
Hey, Rob.
Yeah.
You mentioned the notion of doing some kind of adjustment in relation to what's been happening in our economy, et cetera, the impacts of COVID-19. What are you suggesting to your clients in terms of how they should identify those impacts? What stories should they be telling? And what do they need to be saying to a potential buyer? I've certainly seen a lot of circumstances where businesses are looking around for a buyer in almost desperation, and that's if your messaging isn't good, that can come across in the wrong way, I expect. So
Right.
How do you view that?
Yeah, I mean, we've actually had ongoing conversations inside our office about what financial statement presentations might look like. Most of the businesses we deal with were able to obtain PPP loans from the SBA, and we're anticipating that most of those will be forgiven. And it's not clear where that's going to show up in the financials. It's going to be income when it gets forgiven. The AICPA has generally taken the position to put that down in below the line in other income. But I can make a good argument that there's a lot of expenses that were incurred, say above the line. A lot of employees were retained and people were paid only because they obtained those PPP loans. So I do think it's important to try to come up with either, whether you can do it in your base financials or in some kind of pro forma presentation, to highlight expenses that either you only incurred because you received these funds from the government or extraordinary aspects that you had to take during what we're hoping is going to be a limited period of time. And to the extent that you can separate it out from what the normal business and operating expenses are, that's what's important. And that's what happens in the due diligence phase anyway. The buyer's due diligence group is there to try to determine what's a normal working capital look like. What is a normalized P&L for the company? So you're better off on the seller side to try to do that ahead of time as well.
Got it. So as we look forward and we think about 2021, and maybe we have, business owners who are listening to this program who are thinking about the end of 2021, what are the kinds of things that they should be doing or focusing on, given your levers of value, in order to increase their value in a difficult time?
Well, I think one of the aspects to keep in mind from a perspective of valuation is growth. Growth typically has been viewed as a major or the major factor in what potential buyers might be looking for in terms of historical and potential growth. So to the extent that you're able to put together those historical financials, but then put together budgets or projections going forward as far as you can. I mean, at least a couple of years if possible, understanding in this environment, there's going to be a variety of things to look at. But not just the projections themselves, really in terms of how is the business operating? To the extent that you can, not to let your aspects that you do in your normal growth of your business, don't let it stop. Don't stop your normal research and development. That's really what the larger businesses are looking for from you anyway, is your ability as a smaller business to be more creative, to come up with more innovations. And if you have to stop the R&D, that's going to limit your growth and it's going to limit your value. So I think you want to be able to continue to reach out to new markets, almost from the perspective of irrespective of the situation that we're in, but understanding that there's limitations. And really important to really circle in your management, your key management, and broader pieces of your business, employees in your business to be part of that goal. We heard from one of the speakers earlier today in terms of the benefits of utilizing their younger staff, and to the extent that you can put more people inside your organization, putting their thinking hats on about creative ideas to grow the business, expand your markets. You never know where those good ideas are going to come from, plus great new leadership that could arise in the organization.
That's great, Rob. Thank you for your comments. Let me move over to Rick at this point. Obviously, one of the important factors in business is to have capital funds available. A good banking relationship certainly comes in handy, but at a tough time, having a good relationship with your lender in a pinch is certainly valuable. So, as you're talking to your clients, your bank customers, and they start talking about succession planning or preparation for a sale, what are the kinds of things that you ask your client leaders to focus on as they prepare for such an event?
Absolutely. Well, I think, first of all, we want to understand what type of a transition is being contemplated. Is it going to be a family transition where you're passing it to a next generation, or if it's going to be to a third party type situation? In either of those situations, I think the approach is different. We talked about capacities and capabilities of next generations. We'd have to assess that. If it's a third party, is it a third party situation where you're planning on handing over the keys and just walking away, or are you going to stay involved with the business? And if your existing management team is going to be involved going forward. These are kind of like fundamental questions that have to be addressed and can approach, how you're going to manage the transition, if you will. We've seen situations where companies have transitioned into next generation, where let's say a father or mother, transfers to the next sibling, their siblings, 2 or 3 kids, and the businesses, while it supported the original family, if you have now 3 families to support, could be challenging. And those kind of fundamental understandings, I think, are important in addressing how you want to manage the transition. But taking a step back, from a banker's perspective, we can be kind of that third-party neutral person who just asks the right questions. Fundamentally, why is your business successful? What do you do that your customers desire, that give you a future, and reliance on the customers rely on you to provide value to their situations. And having a good understanding of what that is and what you provide to the marketplace helps the banker and or other purchasers, provide, I guess on the purchaser side, the value that they're willing to pay. On the banker side, the concept of continuation of cash flow. Because, bankers, they're not necessarily investors, we're lenders. So we provide money and then need the money to come back. And having a feeling for where this money is going to be generated in the future really stems from the consistency of the value that the company provides to its customers and the reliance that may be there. Those kind of fundamental questions we look to address and help out.
Got it. And so you're there as a banker who wants to get their money back, as you just said. But, you know, I know many bankers have long-time relationships with their clients and are certainly looking to be a resource that's valuable. So what are the kinds of things that a bank and a banker such as yourself can do to assist with that process, and some thoughts for our executives in terms of how they might utilize their banker in a helpful way?
Well, certainly there's obviously many types of financing structures and programs that are out there. Having the knowledge that your banker can provide is the different things that you may want to acquire as far as financing programs. You may not have that knowledge. Having your banker with that knowledge helps you to take advantage of the type of financing that makes the most sense for what your needs are. And I think that's where the matching the proper financing with the need is critical to the ongoing success of the program and getting the loan repaid and keeping the business in a comfortable situation.
Got it. Obviously, from your perspective as a lender, one of the things that I know you're looking at constantly is the risk. And this circumstance that we've all found ourselves in certainly has changed the risk profile of corporate America. So I'm wondering, as you look at your clients, how are you assisting them with both evaluating that risk? How are you assessing the risk associated with your customers?
Absolutely. Well, as I mentioned, you know, we're looking at what is the value that your business provides to your customers. And that value depends, the need for that value depends upon how successful the customers are. And so you may be a very good company that does X and Y, but if X and Y is not needed by your customer because they're fundamentally having some issues, that, you know, can be problematic. So looking beyond your actual business into the marketplace as to where the needs can be found is pretty important. So when you have a manufacturing company that makes widgets, if the customers who buy the widgets no longer need widgets, well then just because you can make a good widget doesn't mean you're going to have sales. And it's impacts like that. You have to go beyond the existing company and look into the marketplace to see whether technology is making something change and fundamentally adjusting the needs in the marketplace to where you would have to adapt to that. And that consistency of future business is what helps us understand and help you understand, you know, what type of cash flows can be anticipated in the future.
Got it, Rick. For our business leaders, you know, in terms of their relationship with their bank, you have your existing relationships. What do you want clients, customers to do in relation to their interaction with you if things start to get tough? The results are just not there. They're at risk of potentially violating a covenant, all of those kinds of things, just because of something that is outside of their control.
Absolutely. Well, I think that, you know, fundamentally there's always talk about, you know, bankers don't like surprises, and there's some truth to that. And I think basically when you have a relationship with an existing banker, you want to make sure you're open and transparent as much as possible, because the knowledge that the banker can bring to the table as far as what flexibility is available, the sooner you get into the situation analysis, the better off and the more flexibility you're going to have. So by waiting or sweeping something under the carpet type of thing, and, well, you know, I'm holding back on this information for as long as possible, that's not really a good situation. You're better off being transparent. Here's the situation. Here's how I think I want to resolve it. You know, if the banker has some suggestions or observations from other clients that may be able to bring to the table, alternatives that you may not have thought of, it's communication. So I would say communicate early and often is the best way to address a challenging situation.
That's great. At this point, I know we have a variety of people that are on mute. We also have the benefit of the chat function. If you have particular questions that you'd like to throw into the mix, we're welcome to, we'll be pleased to take those. So feel free to either unmute and share your question, or alternatively, send us a question through the chat function. Okay. I'm just monitoring. I wanted to go back to Joseph in relation to the risk question that I was asking Rick about a moment ago. You know, lawyers are in part advisors, but we're always looking around for the risks of the current situation, and certainly managing the financial risk and then thinking about doing a transition in this time period is certainly tough. It's a unique environment. So I think, Joseph, you need to unmute, but once you've done that, if you can provide your thoughts, that would be great.
Absolutely. So on COVID particularly, what we've been seeing in the markets is buyers obviously adding reps and covenants in the purchase agreement to allocate COVID risk to the sellers. The problem is that COVID is so fluid. The regs, everything surrounding what's going to happen in the environment. The point of view, at least on the sell side, that we've been taking is that you know as much as we do in terms of what is going to happen with COVID, which is it's a huge question mark. We don't know if there's going to be a vaccine. We don't know the permanent impact of the marketplace. We don't know the permanent impact to society based upon what's going to happen. So therefore, to ask the seller to bear the risk of that unknown is not fair. Let's agree that it's an unknown and we'll mutually share in that risk by not putting in specific provisions that tie the risk to the seller, or better yet, when we represent a seller, we would actually add provisions. Take, for instance, in the material adverse effect provision that says there is no impact on COVID for purposes of the interpretation of this provision. There is no closing condition that is tied, take, for instance, to any further effects of coronavirus.
Got it. And let me go over to Tom. I'm just wondering, you know, Tom, as you've been advising clients, it's certainly a challenging environment for everyone in terms of consulting, and certainly, you know, we're all encountering rather unique circumstances with a lot of our clients and customers. So I'm wondering, what are you seeing that is a unique challenge for a lot of business leaders as they try to think about moving a business forward, transitioning it, getting it ready for sale? How does this present, this particular time present a unique challenge?
Well, clearly, in my role as a consultant up until March, much of what Productive Strategies does or did, and much of what I did in my previous career in the search business was based upon personal contact and meetings and reading body language, getting to understand the entire situation, but it was done in person. Now, obviously that's changed, and we've made the transition clearly at Productive Strategies to a virtual environment in which we have had to take what we did in personal meetings and in personal classes and in personal interactions and hone that into a virtual setting, into an online setting. And frankly, what it's done on the positive side, well, you lose the personal, the ability to sit in front of someone or deal with someone in person, which that's a loss. There's no question about it. But what it has done on a positive note, it has made us having to hone our message. It's got to become more efficient. It has to be clearer, and it has to be something that is more easily digested and acted upon by the people that you're dealing with. Now, in terms of leadership change, particularly if you are hiring, the idea of contactless hiring is a little bit daunting for some people, because for the same reason. I mean, it's like back when I was doing this business, it was essential that eventually, at some point, you had to sit down. You had to take the measure of a person. You had to be able to ask them. You had to be able to see how they reacted, and in a real time situation. And that's made it a little bit more difficult, clearly, in terms of how you conduct the search for talent. But by the same token, and I think, and this is particularly relevant for the younger generations who have become who prior to this were much more facile in the online and the virtual world than some of us old ducks, but it's now a situation where I think the first speaker this morning who said, since COVID they've hired 40 people, and the individual's he'd never met them face to face, and he probably won't for the foreseeable future. And so this requires, I think, number one, better preparation. You need to make sure that you know what you need to ask, that you need to know what you are looking for, and you need to be able to express that more directly in terms of just having your thoughts organized, as opposed to an individual situation where you kind of ebb and flow. And so from the negative side, or the negative side of that is you're never really going to be able to take the measure of a person in the flesh, at least not initially. But on the positive side, it forces you to really do some reflection and do some introspection and do some planning in advance, so that you know what you're trying to find out about the leadership, and you also know what is going to work in the virtual environment that we're going to be in for the foreseeable future.
Got it. Rob, I've got a question for you that sort of comes from what Tom was just talking about, and that is, we're working in this virtual environment. Accountants are about keeping good control of various functions and making sure the money's not going out the door in the wrong places. How are you working with your clients to make sure that the house stays in order, so that we have a good, sound financial and accounting structure, as I said earlier, when we come out of the end of the tunnel?
Yeah, it's an interesting question. Although everything has been so much put into technology in probably the last 15, 20 years, much of the control systems that were in place were already based on technology. Certainly from the perspective of a business owner, I think you need to feel comfortable that there are certain controls in place, that you either have access to review certain things to make sure there's not anything unusual going on. The importance of cyber controls has gone way up. And Bob, I know you see it in your practice, as far as being able to identify when there are challenges that are happening. Banks like Rick's Bank have put in many control systems in place to enable companies to feel comfortable that there's not money going out the door that's not being previously approved, or it gives them an opportunity to approve it. So I do think it does take some ongoing creativity to make sure that management and ownership is corresponding and talking to the financial management of the company and the other operational management sides of the company, to make sure that people are comfortable with those controls in place. We have a challenge now as auditors. We have a client right now that's acquiring a company that's based out in California, And there was a need to do a physical inventory to verify the inventory that goes with the closing. Well, the firm that we first got in touch with out in California basically told us they're unwilling and unable to do it because their staff is not being allowed, either by rules based in San Francisco or the county in Northern California, to go to this plant. So I had to reach out to another firm that I know of that did have people that were willing to go on site to look at the inventory. So it was sort of, it's an interesting time right now. And we have this right now, even for our perspective, for our staff. Some people are going to clients and going on site if clients have the right setup, and some are not comfortable doing that. So we have to work around it.
Got it. And Rick, in terms of sort of the banking relationship, obviously the accuracy and availability of financial information is important to you. Maintaining contact with your customers is important to you. Rob talked about some of the challenges in terms of doing things face to face. As you look at trying to strategize with your clients and customers and get them to work on things related to transition or preparing for sale, how are you going about that? And what are some suggestions that you think our business owners ought to think about in terms of coming up with a good cohesive plan while they're distant?
Absolutely. I think, numbers, financial statements are numbers, right? And it's really the banker and the business owner has to have a good understanding as to what's taking place that's forming those numbers, and having a good understanding and depth of knowledge as to how those things are being put together is fundamental. And, in our situation, we normally go to clients' offices and their plants and manufacturing plants, and you walk around and you kind of have to get a feel for how things are in the environment. But in today's situation, that's been more problematic and it hasn't taken place. So to get around that, it's more in-depth questioning. Not that we're, trying to uncover things, but just want to get a greater depth of understanding. And I think the fundamental questions that a banker asks are in that light that we're on the same team. We're trying to get to the same place. And these questions help us understand the financial reporting and what we may be seeing in the numbers, be it COVID impact or non-COVID impact, and understanding, historical, the numbers have been X, but going forward, they're going to be Y. And how is that impact and how long will Y last? That's the big unknown that many of us struggle with. But having some fundamental understanding as to what's impacting the numbers helps us understand and gauge how to react on a going forward basis and to manage expectations in a proper way.
That's great. Okay, so we're coming up on the end of our session, and I just want to do a couple of things. I will tell you that, as you probably know, there is going to be a closing address. For purposes of our attendees, you'll want to utilize your original link to go back to the main session, which is the geniecast.com the President's Symposium of Chicago link that was provided to you previously. And to conclude, I just want to give everybody a final chance, based on what you've heard from your other presenters, to weigh in with any final thoughts on this topic. So feel free when you are ready to roll.
Let me just say that I think that the different perspectives that have been brought to this discussion have been very, very interesting and informative. From the point of view of leadership and management, given where we are and the uncertainty of what's going forward, probably it's more important than ever to make sure that you have the right people. You have the right people in the right positions. In other words, you have to have the right people on the right seats in the bus, and that managing that particular part of of your business is going to be more and more important going forward.
Got it. Anyone else?
Yeah, Bob, I was going to say one thing on the transition side, especially if it's going to a family member group. Oftentimes we think about going from one generation to the next, and let's say there's siblings that are going to take over the company. Having an agreement between the siblings at the onset as to like a buy and sell, because oftentimes there are arguments that develop over in the coming years, and you want to be able to have flexibility to either buy out a family member or something like that. And having some of that stuff discussed up front creates an environment where it's less antagonizing down the road. And it's usually not thought of right away.
That's a great thought, Rick. Having some pre-planning, not only with respect to your executives and the way you're looking at the transition, but how's it going to affect if you've got other owners, making sure everybody's on the same page. Makes sense.
Correct.
Sort of piggyback on top of that, in addition to the family aspect, we talked about the key people aspect. And depending on the motivations of the owner, a lot of clients that we work with, in addition to the business itself, have very strong feelings for the people that are there. And a lot of times there are strategies that can be pursued where the employees or the management are really the people that take the ball rolling going forward. And there are structures and financing available out there to make an organization do something like that, whether it be an ESOP or some kind of management leverage buyout with, usually it means that there's going to have to be some third-party cash. The banks come forward with financing, but there are some creative things to do there that in essence can achieve two things at the same time, where the owner can get the return that they're looking for on the sale of their asset, but at the same time taking care of the people that they've come to feel so close to, that the business succeeds because of them in addition to them.
That's great.
Hey,
Joseph.
Bob, one more thing I wanted to add to that concept is in the transition with businesses going from, let's say, one generation to the other type of thing, oftentimes the seller is looking for a certain value, and that value may have been impacted by today's environment, and the buyer is willing to pay much less than that value. And so bridging that gap, people have to figure out, well, how do we get there? How can we get to a price that someone's willing to pay and a price that someone's willing to sell? And oftentimes there can be a contingency or a portion of the purchase price dependent upon future performance of the company. You could say the company did X in 2019 and therefore I should get paid for that. But going forward, maybe it's not going to be that way in 2020 or 2021. So why should a buyer pay for that value? And you can structure different selling arrangements that if the business does perform to more historical parameters, then the price goes up. But if the business does not perform, then the price is modified down a little bit. So there are different ways of bridging and getting these things together that, counseling with other people who have experience in this area will help you get there.
Got it. Joseph, final word?
Yeah, it's the environment right now, business-wise, is incredibly complex. So unless it's in your area of expertise, you should not be shy about seeking out the advice from us, from other experts that to help you understand what next best steps you may take in your business. So don't be shy on questions, either this environment or reaching out to us individually if you're looking for some specific advice regarding your fact pattern.
That is great. That's great. And obviously for all of you in attendance, you have some great folks here who have provided some real insights on this topic. Very much appreciated. Thanks all. Head back into the general session, please, for the closing address. Again, Rick, Rob, Tom, and Joseph, thanks so much for your comments. Very much appreciated. Take care, everybody.
You're welcome.
Thank you.